Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Paul Rosen, Executive Chairman of GlobalGo. Paul, thank you for joining us.
It's a pleasure. Thank you for having me today.
So what was your background before investing in early stage companies? What did you do before that?
So my career arc is not like a lot of entrepreneurs, not conventional, but my first career, I'm an attorney. I was called to the bar in Ontario, the province of my birthplace in Canada, and I practiced constitutional and criminal law in Ontario for about 6 years in the 1990s. But I ran my own law firm, so I've always been rigorously committed towards self-employment. And even when I graduated law school, I graduated from Canada's top law school, University of Toronto. There were 166 graduating students of the year of my graduation, and I was the only of the 166 that didn't seek employment elsewhere. I went and hung up my shingle and operated my own law firm. And in some ways, I would say that my time in law was really the foundation stone for all of my career ventures since. And I should say, I never became an investor at all. I mean, other than like in Canada, investing into my retirement savings plan, equivalent of like a 401k in Canada. All of my investments were in myself as a self-funded entrepreneur. So quickly, when I left law, I had already started, I guess what we call it a side hustle. Now, at that time, we didn't have such a vernacular. I started an import-export company just because I was interested in developing enterprise aside from my legal business, which had some limitations. Primarily as a service provider, you sell your time by the hour. You only have so many hours in a day, in a week, in a year. And even if you're outstanding, there's still a hard ceiling on how much revenue you can generate because you're selling your own time, and your time is a finite resource, of course. Selling a product, on the other hand, you're able to scale beyond your own time commitment. So I started an import company in Canada. I was importing finished goods of various categories into Canada and distributing it at that time on a wholesale basis to retailers. I sold that company. It was my first exit when I was about 31 years old for a few $1 million. And like all dyed-in-the-wool entrepreneurs, I took all my investment capital and funded it into my next startup, which is a company called SkyPad International, which happily just celebrated its 22nd anniversary. And we're also a fabricator, but we're a custom manufacturer servicing the hospitality industry. Offices in 3 countries, in Shanghai, China, where we manufacture, in Los Angeles, where we have a sales office, and in Toronto, where we have our management office. And I kept on really just working hard on that business, but always keeping an eye on where the next opportunity would be, which for me was entering the cannabis industry in Canada in 2012. Another startup called PharmaCann Capital, now doing business as the Kronos Group, one of the most highly valued cannabis companies in the world. And that's when I really began, if you will, an investment career. PharmaCann, now called Kronos, began as a company that would raise capital from the private markets and then redeploy that capital to invest in other companies that were emerging in the cannabis industry. And this was the first time in my life that I was acting as an investor, and especially acting as a fiduciary for other shareholders, meaning that I was taking risks with other people's capital rather than taking risks with my own capital. And that always imparts a greater level of responsibility upon the director of said concern. And since then, I've just continued to work on launching my own companies. But I did become a pretty aggressive investor, especially in early stage startups in multiple sectors: technology, CPG, healthcare, wellness, cannabis, and have now made directly using my own capital well over 100 investments into a wide array of companies representing a wide array of markets and disciplines.
Well, it's quite a range of experiences, and looking forward to learning more. So what excites you right now?
I mean, I'm an excitable person no matter what. So I'm just always excited about the pace of technological change, which creates all sorts of business opportunities, both disruptive and potentially accretive. I've obviously spent years dedicated towards investing and building companies in the cannabis industry. I think cannabis really is a great durable asset class that's going to have a profound impact upon many aspects of our society and culture. both as a recognized medicine as that gets validated. I see tremendous upside for the cannabis industry delivering novel, non-pharmaceutical, more plant-based remedies that could address a whole range of conditions that affect literally billions of people on the planet. And I also see cannabis as a CPG, consumer packaged goods industry, because we're going to start to see inputs from the cannabis plant making their way across a wide array of consumer products that we already use on a daily basis, be it cosmetics, be it food, be it beverages, even be it textiles. In that hemp part of the cannabis plant can be used to make fabrics, can be used to make objects, durable goods, can replace plastic. So I definitely very bullish on the long-term economic prospects of the emerging cannabis industry. I also like to invest in early-stage technology companies. I think fintech, of course, has been a little side passion of mine for the same reasons that I see major disruption. And I guess just to unpack that a little bit and to speak to your listeners, it's very important, in my opinion, to know when to invest through other people, through a fund, and to also know when it would be more appropriate to invest directly as an investor. When I leave my area of core expertise, such as fintech, where I'm knowledgeable but not an expert, I typically invest through funds that are doing the hard work, the due diligence, and creating the methodology to be able to identify why one company may be superior to another company. And when there's an industry that I think I'm an expert in, such as the emerging cannabis industry, I tend to avoid funds because I don't have any confidence that the fund manager has better insight, intelligence, or information than I have. And it's not so much that I'm averse to the fund fees. I'm just not sure that they really have my expertise. And that's the advice I give to all investors. When you see an asset class that you believe in, but you're not clear how to enter that asset class, and you're possibly going to make a decision based upon not enough information, it's better to identify a fund manager that really has the gravitas and the expertise and has done the work to be able to contextualize why one asset is going to be a higher performing asset than another asset over the long term.
Well, that's good advice for people investing in startups, in particular cannabis. What's your advice for people that are running startups in the cannabis sector? What do you advise them to do before they launch that company?
I would say just generally, the cannabis startup culture is no different than any other startup culture. And the principles that are going to determine success or failure for a cannabis company are going to be the same bedrock principles that are going to determine success or failure of any other startup, regardless of the industry. That being said, cannabis does bring some idiosyncrasies that are sort of symptomatic of a gold rush mentality, meaning that as an industry, as a new industry emerges and it doesn't have years of track record of operators, there are a lot typically questionable people that enter the industry trying to carve off a slice of other people's enterprises. So generally, for all entrepreneurs that are launching their own companies, they have to be good at so many things. But one of the moral hazards is when a startup reaches a point where it needs to inbound investment capital, whether it's equity, debt, or a hybrid product. That is an existential moment for that company and for the founder. And there's a lot of sort of cognitive behavior that can affect decision making. And I've mentored dozens of startups just at that point of intersection where they're just in need and getting ready to inbound investment capital. And there's just a whole bunch of opportunity associated, but also a whole bunch of risks.
So let's talk about the state of investing in startups in general. How is the industry evolving, and what is the biggest change you see coming up in the next few years?
Yeah, that's a great question. We're always sort of real time dealing with the sort of the appetite of the market for funding venture, what we'll call venture funding. And all startups are triangulating risk and opportunity. And just to take a sort of a higher altitude view, there was a gig economy example where companies that were in a hot space like the gig economy and larger companies, WeWork, Uber, Lyft would just be some examples, were getting great attention from venture investors and were able to command really, really high level valuations. In the last 6 months or 8 months, we've seen sort of an unwinding of that thesis that companies that are chasing growth over earnings perpetually are always going to go up in value. So I would say that generally across the venture capital, there has been a little bit of a wake-up call, for lack of a better word, or at least a little bit of a step back to bring more scrutiny and analysis about how a company can become profitable. And we'll use WeWork as an example. WeWork on the round less than a year ago took money from SoftBank, the world's leading sort of tech fund, at a $48 billion valuation, and then found itself 3 months ago, a week away from not being able to make payroll and had to take emergency debt financing from SoftBank, I think with a conversion preference at like an $8 billion valuation. So that really reflects just, WeWork did not change that fundamentally in that 9-month period. What changed is the perception of what a company like WeWork could be worth. We could also use Uber as an example. Now that they've gone public, and we see they report as a public company, must do all of their user data, all their commercial data. And what we see is a company like Uber is continuing to pile up loss quarter over quarter, and the perception that eventually they're going to build enough platform infrastructure to overcome those losses is a long tail bet. And I would say generally, there was a time, and cannabis went through this phenomena, and tech went through this phenomena, where simply being in the industry with a shiny startup was enough to attract investment capital. And that usually is the sign of a sort of a fear of missing out mentality, where investors are making a calculated bet on a future not entirely visible or transparent yet, and are bidding up the equity valuation of these companies. And it now seems in the last year, both in certain types of tech and certainly in cannabis, which was a classic sort of bubble-like emerging economy, that investors are now returning to fundamental quantitative and qualitative analysis. And just being in that industry as a new entrant isn't sufficient enough to attract heat. And so we're just seeing generally that even though we've seen the stock market at all-time highs, the S&P all-time highs, the NASDAQ at all-time highs, the companies that are getting love are companies that are putting up positive, really impressive Q over Q grow earnings, and the companies that are not showing a track record or at least a path towards sustainable growing earnings are sort of falling out of favor. And so I would say the dominant trend in venture capital is just being in the hot space is not enough anymore. The company is beginning to, the venture industry is beginning to engage in assessments as to winners and losers. And let's just use Amazon as an example of a company that sustained massive losses on an operating basis year after year after year, but eventually the size and the durability and the breadth of their platform has unleashed one of the great companies of our generation. I mean, just an incredible company that is making earnings at an incredible rate, and the velocity of the growth of those earnings is going to continue. But it took investors a long-term perspective to get redemption. For years and years, Amazon was still in their building mode, and not every company becomes Amazon. Jet would be an example of a company that did not become Amazon. So what tends to happen when there's hot new asset classes like gig economy, like early internet, like cannabis, is the market is not particularly subtle at making the necessary analysis to identify who are the few winners against the broad backdrop of losers. It tends to favor all companies, and that sort of all boats go up in a rising tide. But eventually, like gravity, fundamentals will reassert themselves. And even in this buoyant stock economy, I noticed that venture capital is engaging in more rigorous quantitative and qualitative analysis than they would have, say, even a year ago, where if you touched it, it went up.
Great. So let's talk about your investment thesis. What's your criteria for investing? What do you look for in a startup?
I'm an early stage investor, so that means that I'm prepared to balance trade-off risk for return. Other investors are going to wait till a company is more proven and maybe enter at a later financing like a Series B or a Series C, and they are prepared to lower their return to also lower their risk. Of course, risk and return operate in a linear relationship. Increasing one increases the prospect of the other. So as an early stage investor, I'm looking for really a number of critical conditions precedent that must be there in order for me to deploy my capital. One is I must believe in the industry that the operator is operating in. So if today someone came to me in an industry that I thought was falling out of favor, like for example, if someone said, I want to get a taxi medallion and then drive a taxi, I would say you're in an industry that's shedding market share. Conventional financial services, I would say you're being disrupted by no free trading platforms. So I have to believe that the company is in an industry that in and of itself is set for high growth. That's a condition precedent. If the industry is not set for high growth, it doesn't make a difference how good is the operator. They likely will not be able to overcome the fact that they're in a low growth industry. Once we're past the, yes, I love the industry, I believe in the potential high growth potential of the industry, then you're going, the next step is, and just sort of self-evident, but it needs to be repeated, is you've got to really critically examine the bona fides of the operator, the entrepreneur, management team that they've assembled around her or him. And we've said, yes, we like the industry, but there's going to be 1,000 operators vying for 10 slots or 20 slots. And so how do we know that you're going to have the right stuff, if you will, to end up becoming a survivor, if not a dominant player in that industry? And that's where you really have to do a deep amount of due diligence on the background of the operators. Show me a success that you've had either in the same industry or another industry. Show me how you've recruited your management team. Show me what their successes are. And if you find that an entrepreneur, ambitious and idealistic as they may be, hasn't really demonstrated success in another venture, it's not to say that they won't succeed, because everyone starts somewhere, but it's, for me, on my scorecard, going to really make it hard for me to overcome that. I really want to see that, what entrepreneurs really need is grit and tenacity, because it's really, really hard and nothing goes up right away. And every company I've ever been involved in, the 12 I've started myself and the 100 plus I've invested in, there was many times where the success of the company depended upon the entrepreneur having enough grit to overcome whatever adversity on their dashboard. And that's just every company in the world. There's no shortcut. So you want to make sure that when the going gets tough, because it will get tough, the founder is not going to be overwhelmed by the toughness, and they're going to just find a way to navigate the company through the risks and get it into the winner's circle. And then the next thing I'm going to look at is the company's balance sheet, really, really hard, and get a reasonable assessment that the company has an understanding about what its capital needs are going to be for at least the next year, and has an equally effective go-to-market strategy. Because there's the history of business is littered by great companies that ran out of money before they could really become great. And so when you are a capital provider, if a company does not have enough capital in addition to your own investment to give them a long runway to execute on their business plan, that's probably a red light to avoid. So you're looking for an industry that you think is going to grow rapidly and likely disrupt another industry, which is very available right now as technology embraces. You're looking for an operating team that has the bona fides, the experience, and the character and the temperament to actually withstand the rigors of startup culture. And then you're going to look very carefully at the company's balance sheet to make sure that even if you've got the right company, the right operator in the right industry at the right time, their balance sheet isn't going to be a liability and end up resulting in a potentially great company not making it all the way across the finish line.
So what are the challenges that startups face today? Is it regulatory? Is it the market? Is it technical? What do you see most of them struggling with?
I mean, it depends on the industry. In the cannabis industry, we are, just as one example, we're a highly regulated industry. So, and to the degree that a lot of the cannabis businesses depend upon the maintenance of a government-issued license, there's always the risk that if you're offside on compliance, the whole fundamental foundation of the business could be threatened. If you're not every industry is somewhat regulated in that you can't break the law, but certain industries are extraordinarily regulated. The medical profession, the legal profession, clearly not tech, as we've seen moral hazard in a lot of tech companies in terms of how they deal with their privacy. But it's always good to act like you're operating in a regulated industry. It's always good to imagine that whatever you do is going to be, as someone once said, just imagine every decision you make is going to be reported in the New York Times today, and that'll help you make, or the next day, and that'll help you make effective decisions. So depending on the industry that one is participating in, there could be an additional regulatory burden. But whether it's an outside regulator or your shareholders or just the market, there's always some degree of oversight. And it's very important for operators to socialize that correctly, to understand that once you take on investment capital, the company is never your own in the same way, and that you're going to have to make room for oversight, whether it's a board of directors, shareholders, or even theoretically a regulator. They're going to judge on a real-time basis all of your decisions. And that does bring a tremendous level of scrutiny that, if dealt with correctly, should improve the performance of a business. But if an operator is too stubborn to accept the oversight that comes with either investors or a regulator, that operator is likely going to fail. One sure way to and not have oversight is to take on no shareholders and no customers, but then you have no business. Once you have customers or shareholders or regulator, you can expect critical feedback on your business.
So in the cannabis sector, what are the particular applications you think are good opportunities for investors to pursue? I know some investors look at the companies that support the cannabis growers and providers and not the actual makers, but those who provide, say, finance support or tax accounting support or what have you. But what do you think are the key applications that investors should look for within the cannabis space?
That's a great question. Sometimes we have a distinction when we're looking at cannabis assets. Are you touching the plant or are you not touching the plant? And so if I'm a cultivator with a license and I'm actually growing the plant, I'm touching the plant. And if I am an accounting firm that is providing accounting services to the said company, I'm not touching the plant. And I'll go back to my risk versus return. In cannabis, we can identify different asset classes. There is the actual cultivation of cannabis. I'm the grower, if you will, the farmer. Then there are all the ways to turn the input into a finished good. Now I am a manufacturer or a processor. And then another company could say, I don't want to do either of those things, but I want to buy your inputs and create a branded product. So now I'm a brand that doesn't require necessarily the farming. And you might say, I don't want to do any of that. I want to be the reseller, so I want to own the store. So I will buy the brands, which require a relationship between the brand development and the growers and processors to create a delightful retail experience. And then we can see companies that are trying to vertically integrate. So they're offering they're presenting in their business model that they will grow, process, and distribute through their own retail network. So we could look at something like Apple Computers as an example of a company that has spent decades building a closed loop system where they want to do everything. But even Apple doesn't do everything. They don't own all their own factories. They use original equipment manufacturers called OEMs to manufacture their products. But they certainly want to make sure that when it comes to the consumer experience, they control the whole outcome. And so we don't look at cannabis any different. My view is that if I break this down into category, farming is probably going to become a commoditized aspect of the industry where we can expect low margin but high volume businesses that are specialists in farming. And then we're going to see that distribution, retail brands are going to have a strong footprint in the market, but we also can imagine that home delivery is going to potentially disrupt brick and mortar stores. And I think we can just look at any immature industry and say what survives. Usually what survives, no matter what, as long as there's demand, and we know in cannabis there's massive demand, are brands and platforms. And so the brand is definitely the emotional experience between the customer and the product. Why do I choose when I go to a supermarket? Why do I choose product A over product B? It's often happening at an emotional or a cognitive behavior level. It's not always choosing the best product. It may be the best packaged product or the one that has the most visible shelf space or the one that your neighbor bought, but it may not always be the best product. And so cannabis is just like any other industry. You got to see where is the ball now, or to use a Canadian term, where's the puck now and where's the puck going? Ultimately, my own thesis is that the platform and the brand are going to be the most durable asset classes in the long run as this industry matures out. But we saw in Canada, where I came up, that there was a period of time where the only real viable asset class to invest in was the cultivation or the farming. So just to use an analogy today, I'm not so concerned about who grew the tomatoes, but I do want the Heinz ketchup, or I'm not so concerned about who grew the beans, but I want the Starbucks coffee. And I feel ultimately that's how cannabis will behave. I'll be less concerned as to who grew the product, or possibly even who processed the product. And as a consumer, I'll be looking to make emotional connections to the brand and the platform.
Well, great. Well, in the last few minutes that we have today, what else should we cover that we haven't?
I don't know. We've done a pretty good whip around the world. I guess I'll just talk to the entrepreneurs a little bit about if that's okay, just
Sure.
about the emotional journey of being an entrepreneur. And I'm a fanatic for advocating for entrepreneurs. I think entrepreneurs are some of the most important stakeholders in our society. As I like to say, entrepreneurs privatize risk, meaning when they take a risk, it's very personal, and if they fail, it's very lonely, and they socialize outcomes, meaning that when they succeed, it's inures the benefit of society at large through employing other people, inspiring other people, paying taxes, ideally making a product that creates positive GDP and maybe even is good for you. So what I tell entrepreneurs is once you start, get ready to give up a lot of your life, but you're going to get something incredible back in return. And my advice is a lot of aspirant entrepreneurs contemplate, think, analyze, which is important, but at some point you got to take the leap. And it is scary. But one thing is that the power of action always begets more action. And you're going to if you could try to overthink your business at the outset, you may never get out of the starting block. The best way to improve your business is to launch it, because you're going to work on a continuous feedback loop of critique, positive or negative. And as long as it's just in your head or in your sketch pad, you can only go so far. You've got to take that dog out for a walk and get a sense about what the market thinks. So in all my businesses, and in almost any business I've had a direct involvement in, those businesses have had to pivot, sometimes micro pivots, sometimes macro pivots, again and again and again. And you can't pivot until you start. So I encourage entrepreneurs not to be reckless, not just to jump in pell-mell regardless of the analysis, but you can get analysis paralysis, which is usually fear. Fear is a good healthy instinct, but it can sometimes impede us from doing what we should be doing. And I really do encourage entrepreneurs, if they're really committed, not to delay their launch, just to get out in the market quickly, because everything that you're doing will speed up quickly. And don't be afraid of failure. We live in a culture that seems to, for whatever reason, take pleasure in other people's failure. Entrepreneurs, we know we're going to fail a lot of the time, but when we succeed on a massive level. Most great entrepreneurs I know have had so-called failures. They would never use that word failure because it's stigmatized. But you can't be afraid to stumble a little bit. If you're, what do we say? The cautious seldom err. If you want to lead a great life as an entrepreneur, you're going to have to be prepared to sometimes err and not turn it into an existential personal crisis, but to see it as an inevitable step towards the building of a great company.
Well, that's great advice. So how best for listeners to get back in touch with you?
My Gmail is always available. If anyone wants to reach out to me by Gmail, they can reach me at paulrosen44@gmail.com. And they can also find me on LinkedIn, although I, like a lot of people, forget to check my LinkedIn despite all the daily alerts and updates. So email is always the best. Of course, I try to respond to everybody. If you are emailing me in response to the show, please identify that so I'll know how you found me, and I'll do my best to get back to you quickly. And to all entrepreneurs, everyone with great ideas, everyone that is looking for investment capital and really believes that you've got something incredible, I'd love to hear from you.
That's great. Well, thank you for joining us today, and hope to have you back for a follow-up soon.
Well, it's been a pleasure. Thank you for your interesting questions, and thank you for the opportunity to speak to your audience today.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.